Imagine, for a moment, the world's energy lifeline suddenly brought to a halt. The Strait of Hormuz, a narrow waterway that might seem inconspicuous on a map, suddenly becomes the epicenter of global tension. Today, Iran has officially declared the closure of this crucial maritime corridor, sending shockwaves through financial markets, energy sectors, and diplomatic corridors worldwide. The announcement didn't occur in isolation. It followed a cascade of escalating incidents that have thrown the Middle East into a state of tension not seen in decades, raising fears of extended conflict, severe disruptions to energy supplies, and a surge in global oil prices that threatens to ripple across every corner of the global economy. To grasp the gravity of this situation, it's vital to understand that the Strait of Hormuz is far more than just another shipping lane. It is the artery through which nearly 20% of the world's daily oil consumption flows. A choke point so critical that even a partial closure has immediate, dramatic, and far-reaching consequences for global markets and the cost of living. Before we dive deeper into the implications of Iran's decision, make sure to hit that like button and subscribe, because what's happening here isn't just a regional issue, it's a turning point shaping the future of energy, security, and daily life for billions of people worldwide. The Strait of Hormuz connects the oil-rich nations of the Persian Gulf, including Saudi Arabia, the United Arab Emirates, Kuwait, and Iran itself, to the wider world. Every day, around 20 million barrels of crude oil traverse these narrow waters, along with significant volumes of liquefied natural gas. When the strait operates normally, the world's energy markets enjoy a relative stability, a rhythm of supply and demand that, while never perfectly predictable, allows economies to function without sudden shocks. But when that passage is threatened or closed entirely, the effects are immediate and severe. It is a choke point that magnifies the leverage of whoever controls it. And when Iran's Islamic Revolutionary Guard Corps issued a statement declaring the strait closed, warning that any vessel attempting to pass would be set ablaze, the message was stark. The conflict had entered a new and perilous stage. The immediate repercussions were felt across the globe. Ships returning to port, maritime insurers withdrawing coverage, commercial operators rerouting vessels around the long and costly journey around Africa's Cape of Good Hope, weeks added to journeys, freight costs skyrocketing. All of this unfolded amid a broader region-wide escalation, fueled by soaring tensions with the United States and Israel. To understand why the closure of the Strait of Hormuz carries such a dramatic weight, one must appreciate the scale of its strategic importance. The strait channels roughly 1/6 of global oil demand, along with substantial shipments of liquefied natural gas. In normal times, blocking this flow would be almost unimaginable. Yet, in times of geopolitical tension or open conflict, it becomes one of the most powerful levers any state can pull. Markets responded with astonishing speed. On the day the closure was announced, Brent crude, the global benchmark, surged as much as 13% in early trading before easing somewhat. Prices that had been stable for months suddenly drew comparisons to previous supply shocks, such as the disruption caused by the Russia-Ukraine conflict in the early 2020s. But the fear-gripping markets extended beyond crude oil. The strait also supports a significant share of global LNG shipments and fertilizer trade, meaning its closure threatened not just fuel prices, but industrial supply chains spanning continents. Analysts cautioned that prolonged disruption could trigger price spikes, rivaling or even surpassing those experienced during prior crises, creating inflationary pressure for governments and households already contending with high energy costs. For ordinary people, these price spikes are more than numbers on a screen. They translate into higher costs at the pump, rising heating bills, and the creeping sense that global events beyond their control can immediately affect their everyday lives. In the United States, gas prices in some areas surged above $3 per gallon, a level not seen since late 2025. Airlines warned of rising fuel costs. Shipping companies faced dramatically increased freight rates, and insurers hiked premiums for vessels operating near the Gulf region. Within days, transporting energy products through the Middle East hit record highs, reflecting the risk premium priced into global oil and gas supply chains. But the economic impact of closing the Strait of Hormuz extends beyond oil prices. Shipping data revealed a sharp drop in vessel traffic, as operators chose to avoid the narrow passage rather than risk missiles or naval confrontation. Some ships remained stranded, waiting to see if maritime routes would stabilize or if alternative passages could be negotiated. Global stock markets reacted with palpable anxiety. Asian and European indices fell as investors digested the economic risks of a prolonged energy crisis, while commodities surged particularly oil, gas, and metals. Analysts warn that even if some market moves were temporary, sustained closure or intermittent disruption could unleash prolonged volatility across global financial markets. The strategic importance of the Strait also underscores the broader geopolitical risks confronting major energy consumers. Asian nations reliant on Gulf oil, including Japan, South Korea, Taiwan, and Singapore, braced for economic pain. China, a major importer of Iranian crude, condemned the escalation, complicating diplomatic efforts to stabilize the situation. European nations, already navigating high energy prices and the pressures of transitioning to renewable energy, monitored fluctuations anxiously. Analysts warned that extended supply disruptions could send European natural gas prices soaring, potentially tripling in extreme scenarios, with wholesale prices reaching $100 per megawatt hour or higher, reverberating through household heating costs and industrial energy budgets. Iran's closure of the Strait was framed as a response to foreign aggression, a retaliatory move against U.S. and Israeli military actions that had shaken the Iranian leadership. Iranian commanders vowed severe consequences for any vessel attempting to transit the waterway, signaling a readiness to employ missiles or other military assets. This threat is significant because the Strait is not only critical for oil, it channels liquefied natural gas from Qatar and the UAE, as well as materials essential to the global fertilizer and chemical industries. Disruption here does not simply affect fuel, it reverberates through multiple sectors of the global economy. OPEC nations scrambled to respond. Some promised to slightly increase production quotas to offset supply fears, while others emphasized regional stability as vital to global energy security. Yet analysts cautioned that even increased output might not fully counteract the impact of reduced tanker traffic or a prolonged closure. In the United States, political debates intensified. Some leaders advocated immediate diplomatic engagement to prevent a sustained energy crisis, while others pushed for a stronger military posture to safeguard freedom of navigation. Economists warned that surging energy prices act as an effective tax on households worldwide, feeding into transportation, manufacturing, and food costs, and creating broad-based inflationary shocks. Shipping companies recalibrated their operations, rerouting freight through longer, costlier passages to avoid geopolitical risks. These extended delays amplified economic effects beyond fuel alone, raising prices for electronics, consumer goods, and industrial supplies. The economic stakes were clear. A disruption in one narrow waterway had cascading effects across supply chains, markets, and households. Despite the widespread alarm, some analysts saw potential for diplomacy to mitigate the worst impacts. If Iran and the United States could find common ground, or if alternative logistics solutions could be negotiated, the global economic shock might be less severe. Yet the rhetoric from all sides made a swift resolution seem unlikely. For ordinary people, the closure of the Strait of Hormuz became a tangible reminder that geopolitical conflicts can reach across continents, altering daily life. Rising fuel prices, higher heating bills, and looming uncertainties about food and industrial costs brought the distant Middle Eastern tensions directly into the homes and wallets of consumers worldwide. As governments monitor the situation, military forces remain on heightened alert, ready to respond to further provocations or threats to this strategic waterway. The Strait of Hormuz has long been a linchpin of global energy trade. Its closure underscores just how vulnerable the global economy is to geopolitical shocks, and how a single decision in a narrow stretch of water can reshape markets, affect households, and influence the trajectory of international relations. Whether the closure persists, eases, or evolves into a negotiated reopening will determine the course of energy markets and economic fortunes for nations around the world. One thing is certain. When the Strait of Hormuz is closed, the effects ripple far beyond the Gulf, filling fuel tanks, reshaping freight schedules, rattling markets, and altering the global geopolitical landscape in profound and unpredictable ways. As the world watches, the closure of the Strait of Hormuz is not just a temporary disruption, it's a strategic chess move with consequences that could echo for months, perhaps years. Every decision made in the coming days will carry outsized weight, from military maneuvers to economic policies, and from diplomatic negotiations to corporate strategies. Iran's move has laid bare the fragility of the global energy system and the degree to which geopolitical tensions can instantaneously translate into financial volatility and human hardship. It is a stark reminder that in an interconnected world, a single waterway in the Persian Gulf can dictate the rhythm of global trade, influence the prices on supermarket shelves, and even shape the political fortunes of nations far removed from the Gulf itself. Military analysts caution that the situation is precarious. The waters around Hormuz are narrow, congested, and heavily monitored by multiple naval powers, including the United States and allied regional forces. Any confrontation, even minor, carries the risk of escalation into a broader regional conflict. The presence of mines, patrols, and missile-equipped vessels creates a tinderbox scenario where a single miscalculation could provoke retaliatory strikes or a chain reaction of military engagement. For commercial shipping, this is a logistical nightmare. The risk assessment for insurers has shifted dramatically, with premiums rising exponentially for vessels daring to enter these waters. Cargo rerouting around the Cape of Good Hope is possible, but costly, adding weeks to delivery times and driving prices higher for goods that have nothing to do with oil. Electronics, consumer goods, industrial machinery all feel the ripple effects. Beyond the immediate financial and logistical concerns, there's a deeper geopolitical story unfolding. Iran's leadership has framed this closure as a response to perceived aggression by the United States and Israel, presenting it as a calculated show of strength meant to signal regional and global audiences. Tehran knows the strait is more than a local conduit. It is a lever of power. By exercising control over Hormuz, Iran is asserting its strategic relevance on the world stage, testing the resolve of superpowers and probing the unity of alliances. For the U.S., this is a challenge not just of military strategy, but of credibility and influence. For Europe and Asia, it's a test of energy resilience, of supply chain adaptability, and of the capacity to withstand economic shocks from afar. The human cost of these geopolitical tensions cannot be overstated. Families filling their gas tanks, industries calibrating their budgets, nations planning for winter energy needs, all of them are caught in the crosshairs of decisions made thousands of miles away. Rising prices, delays, and uncertainty erode consumer confidence and, in some cases, deepen societal anxieties about stability and economic security. For countries already grappling with inflationary pressures, the closure of Hormuz is like a sudden tax on every citizen, a disruption that is both unavoidable and profoundly consequential. Economically, the ramifications extend well beyond energy. Fertilizer shipments, essential for global agriculture, are at risk. Manufacturing inputs, heavily reliant on steady supply chains through the Gulf, face delays and cost increases. Even companies far removed from oil trading are recalculating risk, adjusting forecasts, and considering contingency plans. The global economy, already delicate in a post-pandemic and post-conflict world, is reminded that interconnectedness, while a source of efficiency, is also a vector for vulnerability. A bottleneck in one narrow stretch of water can cascade into shortages, inflation, and political headaches across multiple continents. Diplomatic efforts, while ongoing, face steep challenges. Negotiating an end to the closure, or even a temporary partial reopening, requires navigating not just the immediate interests of Iran and the United States, but also those of regional powers, energy importing nations, and international institutions. Each actor carries its own agenda, and the stakes are enormous. For instance, Asian energy importers like Japan, South Korea, and India must balance the need for uninterrupted supplies with geopolitical alignment, while European countries weigh energy stability against broader foreign policy considerations. Any misstep or miscommunication could prolong the disruption, exacerbating both economic and political instability. Meanwhile, analysts warn that even short-term closures can leave lasting scars on markets and infrastructure planning. Investment in alternative energy routes, storage facilities, and strategic reserves could accelerate, reshaping the global energy landscape for decades to come. Companies and governments may be forced to consider more resilient supply chains, diversifying sources and routes to avoid future dependency on a single choke point. This recalibration could ultimately transform the economics of energy and trade, influencing everything from shipping contracts to national security doctrines. For ordinary people, the crisis unfolding in Hormuz underscores a sobering reality. Global stability, economic security, and even daily life are more intertwined than most realize. A decision made in Tehran can affect the price of milk in New York, heating costs in Berlin, and airline tickets from Singapore to London. The closure of the strait is not just an abstract geopolitical event. It is a tangible disruption with a human face, one that reminds us of our collective vulnerability in an increasingly interconnected world. As the days unfold, military postures remain tense. Negotiations continue behind closed doors, and markets watch every signal for clues about the next move. The Strait of Hormuz has always been a strategic linchpin, and now it has become a stark symbol of how geopolitical volatility can intersect with economic vulnerability. Whether Iran's closure becomes a protracted crisis, a short-term disruption, or the catalyst for broader conflict, the world has been reminded that the flow of energy and the stability of economies can hinge on a single waterway, narrow, vulnerable, and strategically vital. The lesson here is profound. In the modern world, geography and politics are inseparable from economics and human welfare. The closure of the Strait of Hormuz illuminates the delicate balance upon which global systems rest. Supply chains, financial markets, national economies, and everyday life all depend on a complex web of interactions, any of which can be disrupted by a single, decisive move. This is not speculation, it is the reality unfolding before our eyes. And so, as we track the evolving crisis, it is worth remembering that these are not just headlines for the evening news. They are a reminder of how fragile stability can be, how closely global systems are intertwined, and how a single action in a narrow stretch of water can reverberate across continents, markets, and lives. The Strait of Hormuz may be just 21 miles wide at its narrowest point, but its closure has made it the focal point of global attention, a reminder that the decisions of a few can impact billions. In the coming weeks and months, the world will watch carefully. How will Iran manage its position? How will global powers respond? Will diplomacy prevail, or will the strait remain a flashpoint for conflict and economic disruption? The answers will shape not only energy prices, but the broader trajectory of international relations, economic resilience, and everyday life for billions of people. One thing is clear. The Strait of Hormuz is more than a waterway. It is a warning, a challenge, and a reminder that in our interconnected world, no nation, no economy, and no individual exists in isolation. Stay tuned, because the story is far from over. As markets fluctuate, military postures shift, and negotiations unfold behind the scenes, the implications of this closure will continue to ripple outward. And for everyone watching, the lesson is unmistakable. The fate of one narrow strait in the Persian Gulf can change the course of the world in ways we are only beginning to fully comprehend.